So, usually when the economic forecast calls for a storm fueled by, high inflation and surging mortgage rates, you expect commercial real estate investors to just, well, board up the windows.
Right, to just sit on their cash.
Exactly. Just sit tight and wait for the skies to clear. But I mean, if you look out the window in Dallas-Fort Worth right now, you see billions of dollars being poured into massive new construction projects.
Yeah, and really high-stakes retail acquisitions, too.
Yeah, it's wild. So today we're doing a deep dive into an exclusive stack of data provided by Eureka Business Group. They're the experts on the ground in DFW commercial real estate.
Specifically specializing in retail, which is key right now.
Right, exactly.
Yeah.
So they handed us this data from late May 2026. And our mission today is to find out exactly why the smartest money in the world is basically running directly into the storm.
It's a fascinating contradiction, honestly, when you look at the raw data.
We want to give you an unvarnished look at how a totally turbulent national economy is funneling capital directly into the booming Texas markets.
Because you have these macroeconomic headlines that just look terrible for real estate, right? Inflation is running hot. The cost of debt is painfully expensive.
Painful is a good word for it.
Yeah, but at the very same time, we're seeing massive bank lending and just explosive earnings in specific retail sectors. So when you filter out the noise, you realize capital isn't fleeing the market at all.
No, it's just getting picky.
Exactly. A highly disciplined playbook is emerging. Investors are becoming incredibly selective, and they're overwhelmingly favoring the Sun Belt.
Okay, so before we talk about where the smart money is buying, we need to understand the money itself. We got to look at the macroeconomic squeeze.
Right, the actual debt funding these properties.
Yeah, and the picture painted by this May 2026 data is undeniably expensive. Like the April PCE inflation data came in at 3.8% year over year.
With core inflation at 3.3%.
Right, but before we go further, let's just pause and translate that. Why are we looking at PCE instead of, the standard consumer price index that everyone always talks about?
Well, that's a critical distinction. PCE stands for personal consumption expenditures. This is the specific inflation gauge that the Federal Reserve prefers to look at when they're...
Oh, so it's the Fed's favorite metric.
Exactly. It's what they look at when making decisions about interest rates. So because the PCE came in at a hot 3.8%, it immediately signaled to the market that the Fed is not going to cut rates anytime soon.
They're stuck.
Yeah, it reinforced this whole higher for longer rate environment. And that reality immediately pushed commercial mortgage rates up to a 9-month high.
Which brings up a huge contradiction in the data. With mortgage rates hitting those 9-month highs, you would think borrowing would just grind to an absolute halt.
You'd think so, yeah.
But the Mortgage Bankers Association reported that in the first quarter of 2026, bank originations for commercial real estate hit $455 billion.
It's a staggering number.
I mean, that's an 80% jump compared to the previous year. If debt is this incredibly expensive, why are banks suddenly turning the cash spigot back on and lending hundreds of billions of dollars?
Well, they're lending because the market finally has clarity. For the past 2 years, banks were just completely paralyzed by uncertainty.
Right, they didn't know how high rates would go.
Exactly. So they were essentially putting their pencils down on new deals. They engaged in this practice the industry calls...
Extend and pretend.
Yes, extend and pretend. If a borrower had a distressed office or, a retail loan that was maturing, the bank would just quietly extend the deadline.
Just kick the can down the road.
Right. They pretended the asset hadn't lost value because forcing a sale would mean the bank had to officially admit they took a massive loss on that loan.
It sounds a lot like a game of musical chairs, but the banks just refused to stop the music.
That's a great way to put it.
They let it keep playing because they didn't want to admit there weren't enough chairs for all these distressed properties. But it seems like they're finally stopping the music now.
They are. And the music stopped because the 10-year Treasury, which essentially dictates the pricing for most fixed-rate commercial loans, finally stabilized. It settled into a predictable band between 4.00 and 4.25%.
So lenders finally know exactly what the cost of capital is.
Exactly. Because of that certainty, they can accurately price risk again. We're even seeing the CMBS delinquency rate, which tracks distress in commercial mortgage-backed securities. It's actually inched down to 7.54%.
Oh, wow. So it's actually improving a bit.
Yeah, banks are finally ripping off the Band-Aid.
I see that happening in the data with some major discounted payoffs. Like there was a distress note on a major Chicago office building that was just sold off at a massive discount.
Right, I just saw that.
Yeah, it cleared at roughly $30 a square foot. Which, I mean, that sounds brutal for the original owner.
Oh, absolutely brutal.
But it makes sense for the broader market. Like, once you flush that old, bad debt out of the system, you clear the floor so new buyers can enter.
That is the exact mechanism at play. The market has finally accepted the new, higher interest rates. The old, distressed debt is being cleared out.
And now they have that $455 billion burning a hole in their pocket.
Right, lenders are eager to put that money to work. But they are only willing to deploy it into asset classes they view as absolute safe havens.
Okay, so if banks are finally willing to lend again, but they're terrified of taking another loss, they need a sure thing.
Exactly.
And right now, it seems like the only sure thing in the market is dictated by consumers who are actively pinching pennies, which leads us into this massive shift we're seeing in retail.
It's a huge rotation.
Yeah. The Associated Press recently reported that 2/3 of Americans are cutting back on spending because of that stubborn inflation. Walmart even issued a very cautious outlook for the rest of the year.
Which is usually a bad sign for retail generally.
Right. But then you look at the Q1 2026 earnings for off-price and value retail, and the numbers are just absolute blowouts.
The contrast is incredibly revealing. You have Ross Stores reporting a 17% increase in comparable store sales.
70%.
Yeah, TJX reported a 6% increase, moving $14.3 billion in net sales. Abercrombie hit a record $1.11 billion in Q1 net sales. Well, when household buying power is under pressure, consumer spending doesn't just stop, it just rotates.
Middle-income shoppers start trading down.
Exactly. They look for value. And institutional capital recognizes this consumer psychology perfectly.
We're definitely seeing that capital move in massive sweeps. I mean, Continental Realty didn't just buy one shopping center. They dropped roughly $200 million on a 14-property, 2 million square foot portfolio.
That's a huge bet.
And a joint venture between Bain Capital and 11 North Partners spent $300 million acquiring 5 open-air centers.
Right, and JLL just closed a $95 million sale of a center in Omaha to DRA and DLC.
They are aggressively buying up open-air, grocery-anchored, and off-price retail centers.
They're doing that because they aren't just buying the physical concrete or the land. They're buying the predictable, recession-proof foot traffic of people buying groceries and discounted apparel.
Right, because when budgets tighten, people do not stop buying eggs.
No, and they still have to take their growing kids to buy essential clothing. That's why capital is aggressively underwriting everyday needs.
It's like comfort food for real estate investors.
Yeah, exactly. We even saw a company like Slate Grocery REIT suddenly fielding unsolicited takeover bids. Public and private markets are looking at grocery-anchored centers as the ultimate defense against an economic downturn.
But there is a very dark side to this retail story that investors have to navigate, right? UBS issued a pretty stark warning that up to 40,000 retail stores could close over the next 5 years.
Yeah, that's a massive number of closures.
They point to the continuing pressure of e-commerce, the integration of AI, and major demographic shifts. So, if you're an institutional investor, how do you distinguish between a bulletproof grocery center and a vulnerable retail box that might be vacant in 3 years?
Investors are drawing a very hard line between necessity and discretionary spending, and you can see it clearly in how cap rates are shifting.
Okay, let's break that down for a second. A cap rate is essentially the expected annual rate of return on a property, right?
Yes. When a property is viewed as risky, the buyer demands a higher cap rate to compensate for taking on that risk. Because the income stream is less certain, the buyer pays less for the property to guarantee a higher percentage return.
So if I'm looking at a weaker pharmacy asset, for example, the market is viewing that as higher risk right now.
Exactly. UBS warned about vulnerable sectors, and pharmacies are a prime example right now. The asking cap rates on weaker Walgreens locations have widened out to 8.7%.
Oh, wow, 8.7. That's pretty high.
It is. We're seeing similar widening on casual dining net lease assets, too. Franchisees in the casual dining space are facing mounting closures because they're getting squeezed by rising labor costs and food inflation.
Ah, so the smart money is completely avoiding those vulnerable boxes.
Yep. They will accept a much lower cap rate, meaning they'll pay a premium upfront price just to acquire the safety of a grocery anchor.
That makes total sense. So now that we know exactly what this capital wants, necessity, off-price, and grocery-anchored retail, we need to look at the map to see where it's landing.
And the dominant answer across all these sources is Texas.
Always Texas. Texas is not just surviving the macroeconomic squeeze, it is aggressively building straight through it. Like down Houston, HEB filed plans for a massive 99,000 square foot grocery store.
Yeah, it's a Mi Tienda Latino-focused concept at Plaza Americas.
Right, which represents a $24.1 million investment. And Sprouts Farmers Market is aggressively expanding too, adding a new store in Webster.
The momentum in Texas is just relentless, and it spans across so many different metro areas. Over in Katy, Phillips Edison and Company bought Firethorn Plaza.
That's the nearly 30,000 square foot center, right?
Right, and it's 100% leased, specifically targeting grocery-anchored demand. Down in San Antonio, Centeco's sold the 353,000 square foot Legacy Lifestyle Center.
Which is huge.
It is. And Nassau Core America stepped right in to provide $37.8 million in acquisition financing just to get the deal done.
It's an incredible volume of deals. But I want to scrutinize this a bit for our listeners. Is there a risk that this capital deployment is just, blind optimism about Texas?
How do you mean?
Well, we hear so much about the Texas miracle. But how closely do these ground-level retail acquisitions actually correlate with the broader population growth?
I see. Well, it's not optimism at all. It's pure math. Institutional investors are simply following the rooftops. Retail doesn't lead population growth, it services it.
So they aren't just building and hoping people show up.
Definitely not. When HEB decides to invest over $24 million into a specialized concept like Mi Tienda in Houston, they are acting on highly specific, granular demographic data.
They know who lives there.
They know exactly how many families are moving into that zip code, and they know the cultural preferences of those families. That data guarantees a customer base before the first shovel even hits the dirt.
So the broad narrative of Texas is growing just isn't enough to justify a multi-million-dollar investment. You really have to look at the exact neighborhood.
Precisely. You have to analyze these growth trends, submarket by submarket. If you only look at high-level generalized data, it can actually be very conflicting.
Do you have an example of that?
Yeah, Houston serves as a perfect example of this. If you look at Houston's industrial market right now, it's currently digesting about an extra 1% of vacancy above its normal levels.
Okay.
Or 100 basis points of excess vacancy, as the industry calls it.
Which means there are just more empty warehouses than usual?
Correct. So if an institutional investor only looked at that industrial vacancy rate, they might assume the Houston economy as a whole is softening.
Oh, I see.
But when you pivot and look at the demographic trends driving the necessity retail sector, the health of the consumer market becomes undeniable. Capital is highly targeted, and right now it is bypassing the empty warehouses to target the direct physical needs of millions of new Texans.
Wow. Okay, so if Texas is the primary target for necessity retail, Dallas-Fort Worth is the absolute bullseye.
Oh, without a doubt.
For anyone listening who is trying to understand how a resilient commercial real estate market actually operates, DFW serves as the ultimate case study. And as a retail specialist with Eureka Business Group, this is exactly the kind of environment where deep local expertise is critical, because the sheer scale of development here is immense.
The numbers coming out of the Metroplex are truly exceptional. DFW currently has 7.2 million square feet of retail under construction.
7.2 million.
Yeah, that doesn't just lead Texas, that leads the entire nation. It's an incredibly aggressive physical expansion at a time when much of the country is, pulling back.
And we are seeing movement across all sizes and formats of retail, too.
We really are. It's not just massive shopping malls. Marcus and Millichap just brokered the sale of Long Prairie Plaza in Flower Mound.
Right, that's a smaller format, 17,000 square foot suburban retail center, and it was fully leased. It shows that even neighborhood level retail is highly liquid right now.
Exactly. And up in Frisco, developers are taking a totally different approach. They're blending luxury residential rentals with experiential ground floor retail.
Like what we're seeing with major projects like the Monarch or the new second rodeo lease over at Firefly Park.
Right. And Hall Park kicking off the next phase of a massive $7 billion redevelopment.
$7 billion. That kind of development requires major infrastructure support.
Yes, and we're seeing the civic investments match the private capital. McKinney Airport recently pushed forward with a $7.6 million taxiway overhaul to accommodate commercial flights.
It's huge for the area.
It is. That single infrastructure project is fueling a massive corridor of growth in Collin County, right alongside a new 715,000 square foot logistics campus.
Let's talk about Collin County for a second, because the demographic shift there is the engine driving all of this. I mean, Collin County has added over 230,000 residents just since 2020.
Which is the size of a whole new city.
Right. But I have to ask the hard question here. Even with that population boom, 7.2 million square feet of retail under construction in DFW is a massive amount of concrete. Are developers risking oversupply?
That is definitely the most important question to ask when you see a number like 7.2 million. However, the underlying fundamentals of the DFW market strongly justify this construction pipeline.
How so?
Well, first, developers today are incredibly disciplined. They aren't building massive retail centers on speculation, hoping tenants will show up later.
They already have the tenants lined up.
Exactly. These projects are coming out of the ground with extremely strong pre-lease percentages. The grocery anchors, the pharmacies, the off-price apparel stores, they're legally locked into leases before the foundation is even poured.
Okay, so the demand is already secured on paper. What about the residential side? You need people living in houses and apartments nearby to actually shop at these pre-leased stores.
That's the second piece of the puzzle. The broader residential context in DFW firmly supports this expanded retail footprint. Over the last few years, the multifamily market in DFW saw a wave of aggressive overbuilding.
Right, there are apartments going up everywhere.
Yeah, but right now we're seeing clear signs that the worst of that apartment supply wave has finally crested and the market is stabilizing. Those new apartment complexes are filling up. That means the residential rooftops required to support all this new necessity retail are safely in place. When Collin County absorbs 230,000 new residents, those people instantly generate a baseline demand for groceries, haircuts, and everyday value retail.
It's not entirely without friction, though, is it?
Yeah.
As a local expert, you have to navigate the pushback.
Oh, there's always pushback.
For instance, the city of Grapevine recently rejected a Trammell Crow mixed-use project,
Right.
and that rejection was driven entirely by local pushback against adding more multifamily development to the area.
That's true.
We're also seeing a severe bifurcation in the older Dallas office stock. The Ritchie high-rise just headed to auction at a steep discount, while at the exact same time, a fully leased Class A office property at the Shops at Park Lane easily traded hands.
Yeah, the friction you mentioned in Grapevine actually highlights an essential dynamic for real estate valuation.
What do you mean?
Well, when a city rejects a new mixed-use development, the entitlement process, the legal process of getting permission to build, becomes much harder.
Right, you can't just build whatever you want.
Exactly. That creates a high barrier to entry for new competitors.
Yeah.
Consequently, the existing retail centers and the developments that are already approved become significantly more valuable.
Well, because supply is restricted.
You got it. So while 7.2 million square feet sounds like an oversupply, it's really just the market working efficiently to catch up with an explosive demographic reality.
So if you are looking at this market right now, wondering what these turbulent headlines mean for your own neighborhood or your own investments, the through line is pretty clear. It is. Despite high inflation and a stubbornly expensive debt environment, the commercial lending window is open. Banks have flushed out the bad debt, and they have hundreds of billions of dollars ready to deploy.
But they are playing by strict new rules.
Right. Institutional capital is aggressively targeting necessity, value, and grocery-anchored retail because they know that is exactly where the consumer is forced to spend their shrinking discretionary income.
And geographically, there is no market in the country capturing this targeted momentum quite like Dallas-Fort Worth. The combination of stabilized residential rooftops and highly disciplined pre-leased construction makes it the epicenter for retail resilience.
Navigating this exact dynamic is why local knowledge is irreplaceable. Knowing which submarkets are effectively absorbing that 7.2 million square feet of new construction and knowing which older assets are facing distress is exactly why Eureka Business Group specializes in DFW retail. They focus on turning these broad, sometimes intimidating macro headlines into actionable, ground-level opportunities.
It's a landscape that strictly rewards forward-looking analysis. And, as we wrap up our review of these May 2026 sources, I want to leave you with one final thought to ponder.
Lay it on us.
We just discussed how necessity retail is winning the capital allocation game today, but the actual management of these retail assets is on the verge of a technological revolution. At the ICSC Real Estate Convention in Las Vegas this May, the dominant conversation was about artificial intelligence.
I feel like we hear about AI everywhere. But how is it specifically changing neighborhood retail?
It's moving rapidly from industry hype to actual day-to-day property management. Landlords are now deploying AI to handle automated lease abstraction, but more importantly, they're using it for highly advanced foot traffic analytics.
Okay, what does that look like?
AI can track exactly how consumers move through a shopping center and correlate that movement with tenant sales in real time. So as this technology scales, we have to ask a critical question.
Which,
How soon will algorithmic decision-making dictate exactly which retail tenants survive in your local neighborhood center? If the data shows a specific store's foot traffic doesn't perfectly optimize the landlord's overall yield, how swiftly will that tenant get replaced by an algorithm?
wow, that completely changes the dynamic of how a community interacts with its local stores. It brings us right back to our original premise, really. The macroeconomic storm is still raging outside, but the financial pipes are far from frozen. Capital is flowing smarter and more ruthlessly than ever before, using strict discipline and entirely new technological tools to find the safest, warmest places in the market.